two stocks represent over 13% of the S&P 500, the most since 1978. Should that be of concern to you? Nah, shouldn't be. Shouldn't be. So in 1978, IBM and Apple, I just gave away. IBM and I just gave away again. IBM and AT&T represented more of the S&P 500 than what Apple and Microsoft represent today. But that's still, this is the most it's been since 1978, where IBM and AT&T represented such a high concentration of the S&P 500. So right now, Apple and Microsoft, which is odd because in 1998, who was that knocking? Who's that knocking? Steve Jobs knocking on whose door? Bill Gates. Bail me out, Bill. Bail me out. Because Apple stock only traded at $7 a share. Crazy. If you only would have listened to Forrest Gump in 1994, when Lieutenant Dan bought some what did Forrest Gump say? He bought some fruit company, and that allowed bubblegum shrimp to become the successful magnet of shrimping industry. In 1994, they're telling us to buy Apple stock. Anyway, pretty interesting. There's no such thing as coincidence. Anyway, so going back now. So now we have Apple knocking on the door of Microsoft in 1998. Now they're both over $2 trillion of market cap. $2 trillion is insane. But here's why I'm not worried about that. And this is also what shows you why S&P 500 is tough to beat, dude, in terms of upside. It's just tough. Because basically financial planning 101 or investment management 101, we don't want any of your individual securities to be more than 10% of your liquid assets. And that your house is not a liquid asset. So if you have $1 million, we don't want more than 10%, $100,000 in any one security. That's an individual stock or an individual bond, just mind you. That's not a mutual fund, because mutual funds or ETF are divided up to a bunch of stocks. All right, so if you let's just say you have $1 million and it's all in the S&P 500, Apple is going to be about 54,000, and Microsoft was it 64,000, something like that. They'll both be under 70,000 each, if that makes sense, because they're both like 6.5% of the S&P 500, something like that. So yes, I mean, there's still lots more room to grow in that regard. But here's why the S&P 500 is so efficient. Because there's momentum. And if you just get this book right now, Benoit Mandelbrot, The Misbehavior of Markets. I've read it twice. Once before COVID, if you will, when the eyes were wide open. Now, I went into COVID pretty wide open, but not nearly to the extent I am now. Because I was always anti the V's, if that makes sense. Because I recognize they've been lying to us for a long time about the V's. Are we looking at our studies on a certain V and we can compare it to a saline, a placebo? No. What are we comparing it to? The previous approved Vs. What? That's what you're doing to validate the efficacy of the new V? You're comparing it to a V that was already approved instead of a placebo? Yes. Oh, that's kind of weird. Once you learn that, you're like, Anyway, so the point being is I had read this book probably 2015, something like that. I can't remember, 2015. I should only see when I bought it. 2017 I bought this, July 2017. So I've read it twice now in those, 6 years or so. And I probably won't read it again. But there's lots of little tidbits in here. And I keep tons of notes about various things. It's just, to go back to... when I kind of like to look back at this, I just like to look to see some of the highlights I had in my scribbles. Anyway, the point being is there is something called trends and momentum. Meb Faber over at the Meb Faber podcast. What the hell is it called? There's the Meb Faber podcast, but he I can't remember what he has something a newsletter you should sign up for. I want to say like a Daily Farm or something like that. I can't remember what it's called. But anyway, he talks a lot about this, and 100%. There is something called trends and momentum. So what happens is the S&P 500. It's more volatile than most funds because it's built on trends and momentum. As certain stocks run, all right, that they become a bigger and bigger component of the S&P 500, and that's where we are today, where Apple and Microsoft are the highest in terms of two stocks that we've had since literally 1978. But even if you look back in 1978, what did the S&P 500 do since 1978? Well, let's take a gander, shall we? Oh, man, hold on a second. I spreadsheet up, but I'm not going to find it. I'm not going to take the time to find it. But From basically 1982 till 1999, we had a run like we've never seen before. The odds were bad, obviously, and then 2009 to 2021 is another run like we haven't seen before. So if you put $100,000, the equivalent of $100,000 today in the S&P 500 back then, we'll say $40,000, whatever it is, you're a very wealthy man. That's all there is to it, dude. Even though it's concentrated, and you had some serious volatility in there. But the issue is because of the concentration, because of the momentum. Again, what happens is you cut your losses and you let your winners ride. That's lesson number one in investing. Part two of that would be my investment philosophy, which is I always sell too soon. And if we look at ExxonMobil, the perfect example of ExxonMobil, when I bought that sucker at like 38 or something like that, because I was in love with the dividend. Yeah, now it's at 105. So I bought this sucker way down here, and then I sold it right there. So I missed another 90% gain. So I sold too soon. So the two different competing aspects of investment, theory is one is you cut your losers and let your winners run. Two is you sell too soon, which means you always take gains. Those aren't mutually exclusive. So what you'd want to do is if you have individual stocks, you'd essentially cut your winners, or you cut your losses, absolutely, but you'd let your winners run, except until a point where you sell too soon. But then you keep the S&P 500 because the S&P 500 is inherently going to do that for you. It's going to let the winners run because that's how they're built. They're built on market capitalization, and as such, nothing gets adjusted. They don't rebalance or anything like that. They just say, hey, this stock keeps running. We're going to let it go and let it go and let it go. And it's going to be tough to beat the S&P 500 solely because of that. Because a lot of people are going to go in there, money managers, they're going to say, I'm going to sell, I'm going to take my gains. And that's great on your individual stocks, but it's not great for the S&P 500. So I'm not in the least worried about the S&P 500 being overweighted in two stocks. It's just, again, we're well away from the 10%, and what makes 10% the risk? It's just a nice round number. I mean, you could say 5%, but if you had 5%, then you have, 20 stocks essentially. And by and large, that's pretty diverse, man. I mean, it depends on what companies, industries, I get that. But, if you had, let's just say you had 100 stocks or $100 and you had 20 stocks at $5 each, one or two stocks isn't going to make or break you. However, if you have 10 stocks at $10 each, one or two stocks could make or break you if they go kaput. You're only left with 8, and then the other 2 are down to 0. So it's a nice round number in financial planning to say, hey, what is a risk reward in terms of my portfolio holdings? Generally speaking, you don't want more than 10% of your portfolio in any one security. And again, security being individual security, not a fund or an ETF. And once you get above 10%, then we should probably take some risk off the table. In this case, we're not anywhere near that. Now, you'll see a lot of people talk about this. Just, man, noise, just all noise. Get them out of your head. It's not worth it. Love to hear your thoughts. See ya.